volume of cases will of course have an inevitable impact on the workforce.
There were shortages everywhere.
A supply chain crisis that affects many countries.
We are working hard to recover the situation across our stores.
You'll hear a lot of companies complain about these things as reporting season ramps up. The cost of doing business has risen as COVID rips through the nation, and this will be a major drag on their profit margins.
I think this reporting season we will see some sectors under enormous amount of pressure. Any company that has labour-intensive workforce are going to really struggle. One of them is mining services because they really need to mobilise the labour force, which quite frankly aren't enough people to be mobilised. And then even the retail sector, we have already heard from a few retailers about how tough some of those situation is.
Wesfarmers, which owns Officeworks and Bunnings, flagged that its half-year profit won't be as good as last year's due to COVID restrictions and rising costs. Kogan and Fortescue Metals also raised similar issues. And Ansell, the maker of this rubber glove here, gave a disappointing trading update this week, which sent its share price plunging 24% at one point, a sign of how nervous investors are these days. Global markets have recently gone into a tailspin on worries about higher inflation and America's plans to lift interest rates several times this year. Australian, US and Japanese stocks briefly fell into correction territory before bargain hunters swooped in. Businesses which don't earn profits or pay dividends may come under a lot of pressure, especially payment apps and buy now pay later firms.
The companies that yet to make money probably will struggle a little bit more. The earnings expectations are already very high, so it's harder for them to meet those expectations. And with interest rate expectations increasing around the world, it's increasingly difficult for those companies to justify their valuation.
Travel stocks will also be in the spotlight. Last month, Qantas slashed its domestic and international flights by a third due to the rapid spread of Omicron.
Travel stocks were still very tough. I think we're not going to go back to the heyday that we saw in 2019. I think business travel is permanently impaired. There's much more Zoom meetings.
Some companies may see a jump in their share price if their results manage to beat the sky-high expectations of investors.
Some of the winners from the previous reporting season will still continue, so the likes of JB Hi-Fi, Sonic Healthcare will still do quite well. Some new winners are likely to be the energy companies. Woodside Petroleum, for example, energy prices are much higher.
Indeed, oil and natural gas prices have jumped to their highest level in years, and the recent tension between Russia and Ukraine has given it a boost. And what about dividends? That's the reason why many people have been putting their money into the stock market instead of, say, a bank savings account where they'll earn next to no interest.
We're not going to see the same level of payments that we saw in August 2021. That was a record year for dividend payers with $40 billion.
The banks are going to pick up in terms of payout, and for this calendar year, we should expect a dividend.
The Australian share market shot up by 17% last year when you include dividends, and analysts are generally optimistic that it'll continue to rise after this round of volatility, but at a slower pace. They say that investors will be driven into the market by the TINA mindset. Now that stands for there is no alternative, as interest rates will still be quite low despite a few potential interest rate hikes this year.